All right, we are recording. Well, thank you everyone for joining. I know a few people are still hopping on, lots of people listening, going to listen to this recording, but we are going to do a condo discussion. All things condos. We've been seeing a lot lately, lots of questions, lots of questionnaires coming back with issues, having an issue getting warrantable condos. If you don't know what that means, then you're on the right call because we're going to talk about it and just things we can ask up front as loan officers and realtors, how to have a better experience for our sellers and our buyers on making condo transactions smoother. So we have two experts from Fairway joining us today, and I'm going to let them introduce themselves, but they are all things condo all the time. I said kudos to you guys because that is not my thing. That's why we bring in the big guns. So we're going to have Q&A at the end, but don't be afraid. I'm going to try to monitor the chat as well. And if it's relevant to what we're talking about in the moment, I'll definitely bring up the questions. So we can get questions answered real time, but we're going to try to breeze through it as fast as possible. So there's lots of time for questions at the end. So hopefully everyone can see my screen, and I'm going to give it over to Scott and Paul.
Great. Thank you guys very much. I won't go into too much depth as Scott's experience, but welcome everyone. My name is Paul Joffrey. If you're reading the introduction there, I'm the VP of Collateral Quality Training and Support over here at Fairway. Just a little bit of background about myself. I've been in operations and risk management for a little over 18 years. I started off as an underwriter with TransUnion. You probably heard that name, one of the credit bureaus, and I've worked my way up since then. Since '09, I've been in mortgage specifically. Been in collateral, which is co-ops, condos, leaseholds, deed restrictions, for the past 15 plus years. 15 years going this year. I've done everything. I've been on the support side where I do front office processing. I've been underwriting, team lead. I have been QC, a trainer. I have built teams. Not only for my prior lender that I worked with, but for Scott over here at Fairway for QC and in training. So slapped on a bunch of hats over the time being. So as Megan pointed out, a lot of firepower between myself, Scott, and our VP of Project Review, Shannon Procknow. I think between all of us, we have just in condos and co-ops, well over probably close to 40 years worth of a background in it. So that's me in a pretty tight nutshell. Scott, I didn't want to steal your thunder. So did you want to talk about your prior experience or your experience now?
Yeah, absolutely. Thanks, Paul. Hi, everybody. Appreciate the time with you today. I'm Scott Figueroa, VP of Collateral Risk. I've been with Fairway for a little over 7.5 years now. Been in the real estate business for a little over 26 years, working in some commercial real estate prior to getting into the mortgage business in 2003. Was with a commercial and residential property management company where we owned and developed some communities. Got in the mortgage business, started on the credit side, kind of moved over to the collateral side in 2008 after, the mortgage business fell apart and I had to start over again. So I moved from the credit side and the collateral side. So I've been doing this for about 16 years now with condos, co-ops, different collateral types, with a few different companies. And like I say, I got the opportunity to come into Fairway about 1.5 years ago, or 7.5 years ago, and help continue the growth of our support for condos, for the street. And then, I brought Paul on to join me and help grow and provide support as well a little bit after I came. So as Paul said, we have a lot of experience here within the condo team. Shannon Procknow, who's our VP of Project Reviews, you may have dealt with Shannon. Shannon's got over a decade of experience as well, coming from the title side and, over 10 years. I think she's about 12 years now with Fairway in her project review experience. So a lot of experience here at the top of our collateral review team.
Okay. Well, thank you guys. You're all, like I said, you are the condo experts, so that is why we're all here to learn. So if you want to get right into it, I'll kind of monitor, but you guys go for it.
Yeah, I can field this too if you want, and then we're going to have a little bit of off-the-cuff discussion regarding new construction. We do have a slide about new construction, everyone, but there's a couple other things that our company does and Scott and I do that pertains to developers. So I'm going to let Scott take the helm on that piece of it. But just little tips for agents. I know one of the big questions, and as Megan pointed out, you'll get a questionnaire or you'll get some documentation and you find out that there's a problem. So here are some things that'll help from a success standpoint that helps us, right out of the chute. Obviously, all of you are boots to the ground. All of you hear things that are going on within condos while you're working the street, while you're working with your borrowers and the sellers, et cetera. So when you're first listing or working with a client looking to purchase a condo, some of the things you want to ask is, do they have any inspections that are structural or mechanical? And this is inclusive of reserve studies that have been completed in the last 3 years. Why do we ask that? That is part of the Fannie Mae and Freddie Mac guidelines now. Okay, anything that has been done in terms of a structural or mechanical inspection, and that, again, inclusive of the reserve study, within the last 3 years, lenders are required to obtain them. So, good upfront question to ask. If they say yes, just get it all and let the experts take a look at it. Has there been any special assessments? Obviously, there's a few places that you can identify that. Definitely the resale cert, if you get one. But if you find out there is a special assessment, there are some supplemental questions that all lenders have to ask. Again, it's in the Fannie and Freddie guidelines. Obviously, what's the special assessment for? When was it approved? And if it hasn't been approved yet or it's planned to be approved, we need to know about that as well. What's the original amount and the remaining amount that needs to be collected if it is current? And what's the expected date that assessment is going to be paid in full? You ask those questions, get them over to us. That helps us out more too.
So Paul, these are questions that listing agents should be asking up front.
Absolutely. Absolutely. If there's a special assessment ongoing, and again, you guys will hear that before we do, and that'll help stave off and streamline the process. Once you have those details, obviously get in touch with Megan, and so she can get it over to us if she can't evaluate it, and we'll look at it and we'll let you guys know if there's any potential impacts to lending. The big thing we really push here at Fairway, we do have a lot of prior to loan application processes in place to ensure that we catch things and we get you guys before we start walking a borrower or a seller down a pathway. A lot of times sellers aren't even aware of a lot of this stuff, and sometimes they get to hear what's going on because they've probably also run into some issues with selling their property. One of the things that we offer too is getting the projects pre-approved. I know a lot of lenders will wait until a loan number is available or an application has been taken. We will look at a project before we go down that route. Okay. We have staff that they can look at stuff outside of our LOS systems, et cetera. So we encourage that as well. And I would encourage that even more if you know that there's a problem with the project. If you're just having trouble with lenders not getting the loans done, or that people have just had struggles, that's a very good red flag to maybe get something looked at ahead of time if you haven't already.
And you guys take us up on
that.
Take your Fairway loan officer up on looking at that up front, because that's going to make you look like a rock star to your seller, and you're going to prevent a lot of problems before it happens. Because if for whatever reason the condo is unwarrantable, meaning it can't go traditional financing, we can market it and look up guidelines for non-warrantable condos up front, so you can list it like that and market it properly. And know what type of financing to use. So you're not getting 3 weeks into a transaction and you're unable to close. These are all things we could prevent up front, and that's going to make you look like a rock star to that seller.
Absolutely. Absolutely. So, with new construction projects, if you have one, if you get the information and documentation to us up front, we have a database that is internal. So Megan and everyone within Fairway have access to review this stuff. We keep it. We hold it. And so if you have multiple deals going in there, say we're able to approve it, multiple deals in there, we can continue to take loans in that building as long as the project is currently approved. So that's something that we have internal. I know a lot of lenders may not. Same thing that goes for an established project. If you have a project that you're getting a lot of business through, maybe that you're the preferred, realtor partner there, or we're the preferred lender. If you get the project over to us as soon as possible, we perform what's called a full review, which is questionnaire, insurance, and budget. We'll look at it. If we're able to approve it, we put it in our database. and we got an approval out there until that expires. So that's a win for everyone across the board, including us, because we only have to look at the project one time and then look at the loan level stuff as loans come in. But that's all stuff that adds to the firepower of things. So we're on to new construction, very, very, very high level. Okay, we're going to talk conventional, we're going to talk FHA, and then Scott has a little bit more information that we can offer up to you guys. That's going to be very advantageous if you have any developers who say buy a piece of land, they want to put a condo on it. We can help them with that as well. So if you're doing a Fannie Freddie direct loan, and chances are if it's anything that's on the conventional side for jumbo or bond loans, they're going to run into very similar guidelines, if not exact guidelines. So for conventional loans, if any of these bullet points are met, then it's a new construction project. So if fewer than 90% or for Fannie Mae and 75% for Freddie Mac have not been conveyed yet, meaning pre-sale, meaning conveyance, sold, etc., it's going to need a new construction review. Okay, anything less than 90% for Fannie, anything less than 75% for Freddie. If any of the project is not completed yet, and that's inclusive of the common elements, that'll cause it to be a new construction project. A new conversion, taking old textile mills. I live in North Carolina, and that's the big thing now, taking textile mills and replacing them into nice luxury lofts. If it's being converted from that ongoing, that's going to be a new construction project. As a developer is adding more units over the course of time to a condo regime, that's going to be a new construction. If the developer has everything completed and they have not relinquished control of the board yet to the unit owners, that makes it new construction. So what that means is that the project can be 100% done. The developer, for some reason, just hasn't completed that piece yet. It's still going to be new construction to Fannie and Freddie and any other lenders that follow that practice. FHA has a lot of differences. So, if you're ever venturing into the FHA space, they look at it as what's called proposed construction. That refers to a property where there's been no concrete or permanent material placed. Digging a footing is not considered permanent. Currently under construction means exactly what it is, period from the first placement of materials to 100% completion with no CO. So the project's just ongoing build. One part of that's unique, if the units are 100% complete, but they haven't been completed or have had COs issued in the last year, within a year, it's got to be more than a year. That's considered new construction to FHA. Okay, so that's kind of a big difference between conventional and HUD. So I'm going to give my throat a break, and I'm going to hand it over to Scott so he can talk about a little bit more about the developer services that we offer here at Fairway. Scott.
Yeah, thanks, Paul. When it comes to new construction reviews, we have a few different avenues that we can take, and it kind of depends on what that property type is. As Paul said, we have some services available. If it's a developer opportunity who's building a new condo and you have the opportunity to get in there as a preferred lender and you want to be, help them along the way, that's something we can assist with. That's something I personally assist with as far as, looking at their draft legal docs to listen to what are they trying to build? Are what they're trying to build, is it going to be a warrantable project? Obviously, what we've seen in the last, decade or so is developers moving from different types of properties into residential development. Obviously, there's a housing shortage still, and condos are becoming more and more prevalent in a lot of markets. And you'll see a lot of developers going, maybe they built apartment buildings or strip malls or, whatever, and they'll say, hey, I'm going to build a condo. Well, what we find that they don't know what they don't know, and what they don't know can be very problematic. But fortunately, we do know. So that's where we can assist them, helping them answer the question, say, what are you trying to build? How, is there commercial space? Making sure that the legal documents are drafted correctly, making sure, is it a project that we should recommend phasing versus one single phase of a project, doing legal phasing? How can we best make that property so it's warrantable faster so we can start closing loans there? So those are services we can help them with. The only thing we can't provide any legal expertise. I'm not an attorney. Nobody on our team is an attorney, but we can review their legal documents and see if they comply to Fannie Mae and Freddie Mac, so that they're eligible. And that's a service we do have available if you come across it. You know, we do quite a few of those in different regions, where we've had some loan officers and some realtor partners who've become, very connected with some developers, and it's been very successful in some areas. They can take a while. I mean, a new construction condo project that's just breaking ground, probably a year or two before we get to the point where they start closing loans. But there's a lot of pieces that fall into place along the way. So those are things that we can assist with. The other aspect of that is just a new construction project that's already been built, and we're just selling those units. Legal documents are already recorded, and they just need to find an end lender. That's something we do internally. We can do that for our project review team. So two avenues that you can go. It really depends on where we stand in the development process. FHA is very complex when it comes to new construction condos. So if you do have a new construction condo that is less than 12 months with their certificate of occupancy, it will require a new construction review, and it is a very invasive, very document-heavy review, which we often will look to utilize a third-party vendor that we work with. There's a couple that specialize in those. There are some fees associated with it. However, their expertise makes it go much smoother and makes it get approved much faster. They have connections within their local HOCs that we don't have, where they can ask questions, and that's what they specialize in. So we do have those support available. It's just not something we do internally. We actually don't do, from an FHA review perspective, we do the FHA single unit reviews. We don't actually do any DELRAP reviews or submissions to the HOC, but that is something that we can assist with, getting projects stacked and reviewed, and submission to the HOC for a review is something we will assist with. We just don't do that review directly in-house. But again, new construction, when it comes to FHA, very document heavy. And if you do run across one of those, not the end of the world, just reach out to Paul's team through the Condo Desk mailbox, or you can reach directly out to myself, and we can get the documentation necessary and have the conversation about what we'll need to do to go down that pathway. I see Paul just moved on to VA reviews, and I'll touch on this a little bit. VA reviews becoming more and more popular. We're starting to see more and more projects wanting to get VA approval. The uniqueness to VA is they provide very little guidelines. In fact, they provide no guidelines. I had somebody tell me that one time, and I was like, no, you're crazy. I don't believe you. But so I went out on a search, and they weren't lying to me. The VA handbook provides very little guidance around any type of condo qualifications, including budget requirements and insurance requirements and things of that nature. They don't specify it. All condos have to have VA approval. So they have to be submitted directly to the RLC for their evaluation. And what you see here on the slide is the documentation that is required to be submitted to them. So the declaration CC&Rs, the bylaws, the articles of incorporation, the budget, the insurance certificates, financial statements, meeting minutes, any addendums or annexation documents, the plat map, and the condo plans. Those are all requirements that VA is going to look at. There's a lot of documents there, but the one thing that we find that we have seen that they're more prevalent of turning down is any type of a rental restriction or a restyle restriction. This comes to play in more markets as we start to see more and more markets pop into their review queue. Some of the things they don't like, any restriction on the ability of selling a unit, if you have to get VA approval to sell a unit, if you have, or not VA, I'm sorry, the HOA's approval to sell a unit, if you have to get the HOA's approval to rent a unit, basically they want our veteran to be able to do what they need to do without any restrictions from the HOA whatsoever. If there's any type of HOA review process, that is something that they typically will decline a project. Because of that, we see a big decline for VA condos in Florida. I know if a lot of people are licensed in Florida, I'm sure you may see some activity there. And they often have restrictions on occupancy as far as who you can rent a unit to, who you can sell your unit to. Sometimes first right of refusals that become problematic. That's the one area that we do see declines for VA. The good thing is, in 2022, the VA rolled out a waiver process to which, after they do their review, and they have to finalize their review and they have to actually reject the project, if they reject it, the veteran can submit as part of their loan process a waiver request where it goes directly to the RLC, and they say, I understand this was declined, however, I'd still like consideration to get a mortgage here. I have not personally done any. I have worked with some loan officers in different branches who've submitted them, and the success rate has been pretty high since they rolled that waiver out. So it is something that, if you do have a project that we look at for VA and you get the documents, I'll usually do a cursory review of the legal docs for you to see, is there any restrictions in there that I think could be problematic? Doesn't mean we wouldn't submit it. I would still recommend submitting it and then let the RLC make their determination. And in the event they do decline it, at least we know, okay, we're going to go down that pathway for the waiver. We just like to bring that up front because it can take 30 days for the RLC to do their review once the documents get to them. So if it's something that maybe there's a shorter timeline, we've only got 15 days to get the closing or something like that, and we know there's going to be an issue with the approval, we can address that up front and decide, is that the best pathway? Do we have to go the VA loan, or is there maybe another pathway that we can look to go for from a timing perspective? So we just like to do that cursory review up front, but I would always recommend, still submitting it to the RLC as long as time permits and have them look at it. The benefit of a VA approval is it never expires.
Yeah. So Scott, I'm glad you mentioned that. I wanted to point that out. So once you get the VA complex approved, you guys, it never expires. So when let's say you have a VA buyer who's wanting to purchase a condo, if it's been sitting on the market, especially for a while, don't shy away from that. Because like they just said, all these things they ask for approval are pretty standard. So if it looks like the HOA is in good shape and there's none of those deed restrictions or anything, I would say go for it. If you have a VA buyer, it's worth having them go through that approval process if it's the perfect house for them. But also too, once you get that condo approved, you go and your buyer purchases it. Let's say you have a VA buyer who goes through that approval process, purchases this condo. In a few years, when they go to sell, 3, 5, 10 years from now, that's going to be permanent. It's VA approved. So you can list it as VA eligible when you go to sell that property for them later on. So I think that's something worth pointing out.
Yeah, I mean, you would always want to check with the VA website to make sure they haven't removed that approval. But as far as just the general expiration, every other review type that we offer, FHA reviews, conventional reviews, they all have an expiration date. VA doesn't. So you would definitely want to keep an eye on it. Much like everything else in the industry, we never know if they may make some changes. Do they become aware of something in a project they may not like, to which they would expire or reject their approval. So you'd always check it. But generally speaking, once it's in there, and we see some that are still on the approval list that were done, a decade ago, and they're still out there, closing loans for our veterans. So definitely an advantageous thing to get a VA approval. Yeah, and Paul, go ahead, Paul. You say something?
Oh no, you're fine. And also, Scott, just to let you know, Megan is actually she's actually turning the slides for us. So to give you guys some insight, everything that Scott kind of said about the leasing restriction piece, it's on this slide. So you don't have to try to remember that or write down notes. So it does speak, and it actually speaks as to why. One of the big things that we tend to forget is that active military personnel, they get called to duty, they got to go. There's no ifs, ands, or buts. So that's actually one of the big reasons why VA is so concerned about leasing restrictions. They want the veteran to be able to go fight for our country without the hassle of going through an approval process, being told they can't rent their property because X, Y, Z. So that's why it's very stringent on the VA side. Also, too, VA is protecting they're protecting their own interests too. They want to be able to freely sell the unit. They want to be able to freely market and rent out the unit if they have to on the foreclosure side. So there's a little bit of give and take to that piece of it.
Paul, do we have the website coming up on a slide?
We do.
Okay, perfect. Somebody asked that in the chat. Just want to make sure. Okay.
Yep, absolutely.
Next slide. Are we good?
Yep, we're good.
Okay.
So. All right. So I know there's been a lot of questions as to what the single unit approval is. I have heard it more than I actually hear the literal name. If you have been in the business for quite a while, you call it the spot approval. Scott and I giggle because we remember the spot approval. That's how long we've been in the business. Probably a lot long, same amount of time you guys have been, or you guys have been on there longer. The spot approval and the single unit approval are not the same thing. The old spot approval was basically, and I make the joke, it's a napkin that had something handwritten on it, and then they would approve it. That is no longer the case. The single unit approval is in depth. It carries very similar document requirements to a full conventional. So if you've heard the term full review, that's questionnaire, insurance, budget. They go a step further. They require financial documentation beyond the budget. They require the legal documents to be reviewed as well. So it is a very invasive review, and our success rate for approval is a lot less than conventional, and that's basically because of the document requirements and the stringent nature of FHA's guidelines in general. And we'll talk about some of the differences on the next slide, but we can review these in-house. They do not have to go to the HOC or the Home Ownership Center to be reviewed. There are some minimum benchmarks that we look at. You are more than welcome to find that as well. The FHA condo database is linked, to this document. So, Megan, if you haven't sent this over to everybody yet, if you could, when you get an opportunity, of course, so everyone has access to it.
Yes, I'll send it to Fairway. So reach out to your Fairway loan officer, and they'll get it to you.
Terrific. So the absolute baseline requirements that we look for, and again, this doesn't mean the project's going to be approved. This just means this is what you have to look for to ensure that you can even attempt a single unit approval. The project has to meet FHA's definition of established. Now, as we said, new construction is a lot different to FHA than with conventional, so you have to keep that in mind. I actually just had to inform a branch that this project that was fully completed, all the COs haven't been issued within a year, so we couldn't do it. But project has to be 5 or more units in size. It cannot be a manufactured home or what FHA considers a site condo. Fannie and Freddie do not have any differentiation between a site condo and a truly detached condominium. So a site condo, in short, is a fully detached condominium where everything, the insurance, the maintenance and upkeep of the property itself, is maintained by the unit owner. The HOA has no skin in it. The only thing that the HOA can do on the unit owner's property is maintain the landscaping. So if it meets that criteria and it's fully detached, it is considered a site condo, which it doesn't require a review at all. Anything beyond that, it's detached and it's going to require some sort of review by FHA, whether it's a single unit approval or project level approval. On the website, FHA does have what's called concentration. That is how many loans FHA holds in that building. If it's over 10%, we cannot do a single unit approval. That's the restriction they place on it. I will tell you that if it's 9.5% and our loan is going to make it 10%, they're not going to allow you to do the single unit approval. And not allow, they will not issue a case number. We have also been informed by FHA that if the current seller has an FHA loan and this new loan is going to replace the FHA loan, they will not do it if it's that close to 10%. So they're very strict with this. One other thing, the project can't be shown as denied, and for obvious reasons, if the project is already approved with FHA, it's not going to require a project level review at all. So that's some of the baseline requirements. So. Okay, so I tried to do a little bit of a comparison document here when it comes to, what's the difference between conventional and FHA that we see holds up files. So with owner occupancy, if you've ever dealt with FHA on the project review side of things, they hold very tight to the 50% owner occupancy. If your project is not 50% owner occupied, meaning occupied by primary and second home residents, they are not going to do it. Conventional is a little bit different. They will allow it if your subject transaction is a primary or a second. If your loan is an investment property, they will do it if the loan qualifies for a limited. So that's one of the big differences that we see. One of the things that if you actually have any questions and you bring them forward to our sales staff, we look at that up front if we have any information on the project, even if it's for conventional. Single entity ownership, Fannie Mae allows up to 20%, Freddie allows up to 25%. If the project is 5 to 20 units in size, they will allow 2 units to be owned by a single entity. FHA cannot own more than 10%. So they're a lot more stringent. Projects that are 5 to 20 units in size, you can't own more than 1 unit. Conventional and FHA follow the same commercial space thresholds. It's 35%. But what FHA wants to find out, they want to make sure that the residential and commercial portions can be independently sustainable from each other, meaning not financially reliant. So that means if you do have commercial space in the building and it's under 35%, for a single unit approval, we have to get financial documentation for that commercial space too. And we have to make sure that if anything goes awry with the residential side or commercial side, they can operate independently of each other. Leasing and rental restrictions, you know, we've already kind of gone over that quite a bit. So fidelity bond, this is another thing, and that's okay, Megan. I can probably quote that to wit. Fidelity bond.
I'm like, do we move?
No,
do we not move? I know we want to move it along, but
no,
like,
you're fine. I'm sorry.
You're the expert. I should have given
Keep
you
these guys awake.
The ability to drive.
No, you're fine. Keep these guys awake. Cause I'm not going to lie. This is dry as a desert. This is my life. So, but anyways, fidelity bond. So what Fannie Mae requires is and Freddie, I should say, the greater of 3 months dues. So if you get a copy of the budget, if you get a year amount of dues, you divide that by 4. That's 3 months worth, or what they have in their accounts. You know, whichever is the greater. That's the standard calculation. FHA takes it a step further. They not only want you to have coverage for 3 months dues, but also what you have in your accounts. So they kind of double down with that. So it is much more difficult to qualify for FHA with fidelity bond. A lot of HOAs will not obtain that much coverage to satisfy FHA. They will take the lesser and almost exclusively go conventional. So it does come into play, and it's difficult. So. This slide here, this kind of talks a little bit about the similar situation to VA when it comes to the review process. So if you don't know the name of it, what the type of review that we can do through FHA if it does not qualify for a single unit approval is called the HUD review and approval process, or HRAP review. If the project is denied in the FHA database, you know, it's always a benefit to reach out to the Home Ownership Center, which we do have contact information for them on this presentation, and see why it was denied. If it's something that, you know, we believe that we can maybe work through with a project level review, we can try to go down that route. Keep in mind, same with VA. FHA, when you submit to them, it takes about 30 days for them to send a response back, and it is purely volume based. There is no rush process as well. I mean, the VA and FHA will move at their glacial pace until they can get it done. But if you have to run down that route for established projects, and we'll go back to that slide. If you can go back to that slide for a second there, Megan. Appreciate it. That's all the documentation that we will need to do an established review. As Scott mentioned on when he was speaking for new construction, FHA, it is extremely laborious, document heavy, and we rely on a third party to assist us with that. So if you see a new construction project for FHA that you want to have a project level review, please reach out to your sales rep for Fairway, and we'll get you guys on board with that. Again, there are fees that are associated with that as well, but that'll get worked out as the process moves on. Thanks, Megan. We can go to the next slide. So some quick VA tips and tricks. I hear this all the time, and I get it because they're very confusing statuses. So I put some of the statuses that you might see on VA's website and what you might see on FHA's. So for VA, accepted without conditions means the project is approved. And again, as Megan pointed out, as a selling tactic and as a marketing tactic, once it's approved, it never expires. HUD accepted. You might see this. They're starting to phase them out. There was a time where VA and FHA shared reciprocity. Sorry, that's a hard word. With each other. So if FHA had the project approved, VA would ride on that approval, and vice versa. That's what HUD accepted means. FHA and VA no longer do this. So if you happen to see the project FHA approved, but not for VA, you got to get a VA approval, and vice versa. Rejected. In the name, it is not approvable right now. Scott mentioned that the veteran can request a single loan waiver. That information more specifically is in that status. So That's a good pathway. Now, again, the veteran has to request the waiver. We can't do it for them, nor can anybody else. So FHA statuses, I'll be brief. Approved means approved, obviously. You can't do a single unit approval because it's already approved. Expired, kind of the same thing. If it is expired, we can do a single unit approval with it. We have to review it. Rejected. Rejected is probably the most confusing status that FHA has. Rejected does not mean the project is turned down and it's non-warrantable. What rejected means in a typical sense is that FHA received documentation from a lender, reviewed it, requested additional information or added conditions to it, never received it. So what they do is they just say, you know what, project's rejected. So you can still potentially qualify for a single unit approval. You can still potentially qualify for a project level review by FHA. It doesn't mean that the project's turned down. So just kind of keep that in mind. Withdrawn, lender advised FHA they no longer need them to review it. Very, very, very quick. And denied, that's the big one. That means it is non-warrantable, turned down, rejected. Well, I shouldn't say the word rejected, considering what we just talked about. So, but you get the idea. Also, a project that is denied cannot qualify for a single unit approval. And last, I always encourage individuals to reach out to the Regional Loan Center or the LRLC with VA or the HOC, the HOC with FHA. If there's any questions about what their databases state. They don't put a lot of comments in. I think if you go into WebLGY, they might put a little bit more detail as to why they did what they did with the project. But if you ever have any questions, those are the 800 numbers to reach out to them. Consequently, too, those links right there, those are links to the FHA and VA databases. So if you ever want to see if a project is FHA or VA approved, denied, what have you, or if you want to see if it'll qualify for a single unit approval with FHA, that's the link you can go into. It's free. There's no login requirements, and it's as functional as you're going to get. So
if you're a listing agent, oh, sorry, I didn't mean to interrupt you. I thought you were done.
Go ahead, Megan. Go ahead.
If you're a listing agent, these are two websites that it'll take you literally 5 minutes. Before you go to that listing appointment, you look up on these websites whether or not, if you're going to a condo, obviously, look up and see if the property is FHA or VA approved. Chances are it's probably not, because there's not many that are, but it could be. And that way you know how to list it in the MLS and you know how to market it, and you're doing some pre-work. If you're up against other agents interviewing for the same property, you can tell that seller, hey, I did the pre-work. This is not listed as VA eligible, but I have a great lending partner who knows how to get it VA approved if necessary, assuming HOA has its stuff in order, right? Assuming those basic things. So it's just giving you some bullet points and some knowledge to share with your buyers and sellers that you know what you're doing with condos. That's what it's all about. And now we're fighting, especially you guys are fighting for that commission. We need to make sure you tell your buyers and sellers, I'm worth it. I'm worth this commission in light of everything going on. This is part of it. The education piece around this is a huge, huge part of it. And I put the links in the chat too. So if you want to copy and paste those into your favorites, that's probably a great idea. And I will go ahead and I'm going to share this information, the PowerPoint and everything with all the Fairway loan officers. So whoever invited you to this today, just reach out to them for a copy, or you can always reach out to me too. I'm happy to send it. But I want to make sure you're in touch with your Fairway person. So anything else, guys, that we want to talk about before anybody have Q&A? Any specific questions anybody's dying to have answered? That's a lot of information.
Be gentle. It could be outside of the government space too. If you guys have questions about things on the conventional side that you're seeing, we're happy to chat about that.
I do want to touch on non-warrantable condos. So let's say you send us information up front, you're about to list a condo, and it turns out it's non-warrantable, meaning non-warrantable means it can't go traditional financing. We're seeing that more and more. We do have broker options for non-warrantable condos. So don't exclude it, but if you know it's non-warrantable up front, that's a great thing to list in the MLS, because not every lender can lend on non-warrantable condos. So you're going to want to make sure you have as much details up front so you get a buyer who's financing with someone who can do those, because it is a brokered loan most of the time. And I'm not going to get into the weeds of guidelines and detail because there's different products out there and they all have different guidelines and we could be here all day. And I know nobody wants that. But your Fairway loan officer does have solutions for that depending on the situation. Like you said, we're seeing a lot of that in Florida, a lot of non-warrantable condos. And I know lots of Illinoisans, is that a word? I don't know, move to Florida. So it might not be a bad idea to have that basic knowledge. But
I have a question.
Yeah.
So the condos, I saw that in Florida, obviously they're coming up, getting the condo property. Do you guys see that here in Illinois too, or just mostly in Florida?
I haven't seen where I've seen a non-warrantable condo it's more because like for example, I've had an HOA in a lawsuit and there's been a huge special assessment and they're not putting enough into reserves. Like typical condo approval, you guys correct me if I'm wrong, but they have to put 10% into reserves. And I've seen HOAs have no reserves. So that makes it non-warrantable.
But not as far as non-warrantable, just in general, just condo purchases. Are you guys seeing that a lot here? Because I know in Florida there's a lot going on, but are you guys seeing that a lot here in Illinois or no?
We are. I mean, I think Florida, unfortunately, is feeling the wrath of the new guidelines that came out in last September for critical repairs and some of the insurance clarifications that just recently came out in May, I believe. So, but we do see them pretty much in all markets. Some markets are a little heavier than others. For instance, we see more insurance issues in places of higher risk. I can't say that the Illinois market's of higher risk. Places like definitely Florida, coastal regions, areas that have a lot of wind and hail events. We can probably rattle off Colorado, California, where the wildfire lines are. We've seen a lot of that, and all that, and essentially what that is that the insurance industry has shifted, and they're placing more and more risk on the HOAs. So if you want that really good deductible, if you want that full coverage, a lot of times you have to pay an exorbitant premium. And if anybody owns a home now, it's not just for condos, it's for everybody. Scott and I have, probably cursed internally at how high our insurance premiums have gone up this year for our houses, and we don't live in an area that's typically considered of high risk. So insurance is really a difficult one right now. Critical repairs are as well, and that's the primary thing that we see across the board through all markets. And really, it's just a matter of the HOA not maintaining the property appropriately, and that kind of falls into what you were saying, Lizette, about reserves, and Megan, you talking about reserves. If you're not funding your reserves appropriately, and sometimes 10% is not enough.
Mm-hmm.
A brand new project, absolutely 10% is probably more than enough to put in. A project that's 40 years old, that's got some wear and tear on it, 10% is probably not enough. But a lot of HOAs do not put that money in. A lot of HOAs don't approve putting that type of money in because it's a lot,
Listen,
so what happens at that point?
I was going to say, I think we see it here in Illinois with older buildings. That's yeah. So if you have like a super old complex, like in Chicago, and it needs a lot of maintenance, that's when we would see that.
We see quite a bit of the older buildings in Chicago. Obviously they're old brick buildings.
Yeah.
We do see some critical repairs, deferred maintenance, a lot of water intrusion things, stuff like that. And the biggest challenge we have with those situations is oftentimes HOAs and management companies being willing to work with us and provide us the documentation necessary to truly evaluate the project. Is it truly a project that is a problem that falls within the Fannie Freddie definition of critical repairs, or is it really just routine maintenance? And in some cases, there's a very fine line between a critical repair and routine maintenance. But when HOAs and management companies say, no, we're not telling you anything, we're not filling out the questions on your questionnaire, we're not giving you anything, there's not much that we can do as a lender or any lender can do as a lender. And I know Paul's team gets a lot of inquiries from, different loan officers all over the country because we get potential rescue deals that have fallen out at another lender because a realtor partner reaches out to them and says, hey, I have a listing, or I'm working with a buyer. And oftentimes it's tighter on these critical repairs. And that's one of the biggest struggles we get as HOAs management companies being willing to work with us. when they do, sometimes we're successful and sometimes we're not. I mean, there are good buildings out there, and then there are some buildings that need some significant repairs. That is really the focus of what these guidelines are intended for. But we do see that in Chicago, and it's really more of those older buildings that are just, you know, getting there to where they have some problems. And the biggest thing we have is water intrusion. That's probably one of the biggest ones, because water is so damaging to buildings and it's so easy to happen. And that's one of the things that, unfortunately, when Fannie and Freddie put out their critical repair guidelines, they specifically called out water intrusion as a critical repair. So that's a pretty big one that we've been fighting. I did see there's a question that came in. I just want to answer Ken's question real quick. We do not charge for a single unit review. We do not charge. FHA and VA do not charge for their reviews. So the only fees that would really be incurred in those cases would be obtaining questionnaires or any documents that an HOA may impose for getting that information. But we as a lender don't charge anything for our reviews. Can't speak for other lenders, how they may do their SUA process, but we don't charge for any of our reviews. In the event that we did a third-party review with one of our third parties for a new construction, there are some third-party fees. But as far as Fairway, we don't charge any fees for those.
And just so you guys know, closing costs. We all should be talking about closing costs with buyers and sellers up front and everything. I don't know if you guys want to share, or I can share, like the typical cost of a condo questionnaire. So like when I'm quoting a buyer closing costs on a condo, you know, there could be HOA transfer fees. There could be, there's definitely a fee for a condo questionnaire. Typically, I think about $400. Am I fair there with that, guys?
Varies by market. Yeah.
It varies. Yeah. We see anywhere from 100, 200 to I've seen 700. I've seen there's some crazy markets that have gone crazy, but I'd say 400 is about probably the average, the norm.
So just something, you know, we should definitely be preparing buyers for, and potentially sellers. If the seller's paying for it, it just depends on what's negotiated, obviously, in the contract and different markets and different things. But those are all costs that I always educate my borrowers on. Appraisal costs. You probably are educating them on inspection costs. So condo questionnaire is definitely something that I've seen. Yeah, I've even seen sellers get them up front and pay the cost. In some states, that's really common, where the listing agent and the sellers will get the condo questionnaire and all the condo docs prior to listing the property, so they can provide all of that. It just makes for a much smoother closing. So if you have a really, you know, a higher price listing and the seller's willing to cover that cost, and you guys get all that up front, it's going to make for a much quicker and less bumpy closing, because we're not waiting on the HOA to provide all of that. I just think that's ideal, but obviously not every seller wants to absorb that cost up front. So we understand that. Any other questions? All great. I mean, great questions, you guys. I actually have a situation that I was asked by a realtor the other day, so I'm just going to share it really quick before we let everybody go. I have a client looking at a condo right now, but there was a fire in one of the units. So condo complex is obviously, it's in good standing, it's warrantable, everything looks good. We've done 2 other loans in this project, but now there was a fire, and the common areas are all now under construction, under repair. Is that something that would prohibit us from closing because there was a fire in one of the units and the common areas are being repaired?
It could. I mean, I think it's something we'd have to look at. I mean, we've done some like that, and we've also had some decline. We've seen Fannie Mae flag projects like that as unavailable as well. It kind of depends on the extent of the damages. I mean, if you go by the textbook definition, the answer is probably the project's not warrantable. However, I think we'd have to look at it. You know, obviously, if there's a fire, if it's a 300 unit project and there's a fire in one building that impacts, you know, a handful of units, is that something we can get comfortable with? That's always something that, you know, we have some abilities to reach directly out to Fannie Mae and get their take on some of those things as well. So if there's a scenario that we're not sure of, and, you know, as much as we like to say we know everything, we don't necessarily know everything. We may think we know the answer, but we don't want to give you the wrong answer and potentially miss out on an opportunity, or say, yes, we can do it, and then have it become a problem with Fannie or Freddie. So, but we do have the opportunity. We can reach out to them and say, here's our situation. But that's a case where we'd have to know, you know, what's the scenario? What's the situation? We have to be able to tell the story to Fannie or Freddie. Say, this is what we're seeing. This is what's happening. Do you have appetite to lend in this property? I think we did have one recently where Fannie was okay with it. They just obviously wouldn't lend in the building that had the damages. So it's just, it kind of, I would say it's kind of on a case-by-case basis.
Okay.
It would probably depend on how much of the property was damaged. Obviously, if it's one building, and it probably is going to be more difficult because now you got damages within the building where we also have residents living. But if it's multiple buildings and it's in a different building, the sad part is, unfortunately, things happen. You have to have insurance for those reasons. But much like everything else, as soon as something happens, it becomes a problem for everybody. And it's kind of the detriment of some of these requirements that we underwrite to. But yeah, we can always reach out and get an answer from Fannie Freddie as well.
Another question in the chat: what if the complex is located in a floodplain? I would assume just proper insurance needs to take place there.
Yeah, they'll have to have flood insurance for any of the buildings and units that are located within the floodplain. So you may have a project. Sometimes you have multiple buildings. Let's say we have 10 buildings and 5 are in a floodplain and 5 are not in a floodplain. The 5 in the floodplain would have to be covered. The others would not, obviously, because they're not in the floodplain. So it kind of depends on what the situation is. But generally speaking, if the condo project is in a floodplain, even if any part of that building touches the floodplain, let's say that the back corner touches a floodplain that runs along a creek or a river, the whole building has to be insured up to the NFIP insurance requirements. So yeah, definitely something we have. And the one thing that comes up occasionally is, let's say we have a townhouse style project, can units cover their own flood insurance? And the answer is not if it's a condo. In a condo, the HOA has to carry a master flood insurance. So there's no ways for us to get around that.
And that's good to know, because those are questions that could be asked up front and figured out up front.
Yep.
Yeah,
absolutely.
Cool. Scott, really quick, Scott Gajewski wanted to share, he just had this non-warrantable situation happen to him. So I don't know if Scott, you want to share any way, like anything you learned or found out, and then I think we'll let everybody go after that.
Yeah, just really quick, insurance, like they mentioned, sorry, I'm in a store right now. Insurance is a big issue, because especially this was a condo in Florida. But make a long story short, master policy was basic coverage, didn't cover everything it needed to, and we had to go midstream from warrantable to unwarrantable, which we got it done. It just is not always, it's not fun, right? It's more expensive. There's a lot more when you go unwarrantable. So one thing that if you can get that up front to double check it, that's good. But it's also a marketing opportunity, you guys, as a realtor and even as the lender, because now we're going to work to try to get this insurance fixed. And now, because right now they didn't know, but they have a 96 unit building that's unwarrantable. So we're going to work to get this insurance hopefully fixed, and then we can go market to it after the fact and help the client switch from warrantable to non-warrantable. So insurance is a key factor these days.
Yeah, it affects resale value.
Insurance is probably, well, we'll say one and 1A between critical repairs and insurance, but insurance is impactful everywhere, and it impacts all projects. And we see a ton of it in Florida. As insurance premiums have risen, HOAs have looked at ways of saving money. We also have somewhat of a discrepancy between lending guidelines and the insurance industry, though. And that's something that I can say definitively Fannie Mae and Freddie Mac and FHFA are in collaboration discussions about how to work through some of these challenges. They haven't come up with solutions fast enough for us to be happy, because we struggle on a daily basis, as do you. Florida, I'm assuming it was probably a citizens policy, which is a basic policy. But there are, yep. That's usually, citizens is your last resort in Florida, and it's only a basic policy. And the funny thing about citizens is it carries a 10% sinkhole coverage deductible, which Fannie Mae won't take. Freddie Mac will take it, but Fannie Mae won't. And there's just a whole slew of challenges we see within the insurance industry, different markets. I think Paul had mentioned Colorado earlier. We see a lot of 10% wind and hail deductibles in Colorado. And in many cases, that's the only insurance the HOA can get, and that's the lowest deductible that can be provided. So my question to Fannie and Freddie is, what would you like them to do? They're stuck in the middle. They can't solve that problem. So that is something that we know you're seeing on a daily basis. I'm sure you're running into it a lot, as are we. We're seeing it all the time. Deductibles, per unit deductibles. We don't see those so much in Florida. We see a lot of them tied to water and things like that that become problematic. So there's a lot of things that have shifted in the insurance industry. But I can say Fannie and Freddie are looking into options and having conversations, but unfortunately, I don't have a time frame on what their solutions may be. I was just on a call about 2 weeks ago with Freddie Mac about what they're working on. The good thing is FHFA is pushing Fannie and Freddie to have the same requirements, and work together to find a solution. So we're not going to be stuck with one coming out with an insurance that's acceptable and the other not having a workaround for it. So that when they do find a solution, it'll be across the board. But yeah, absolutely. I mean, insurance, especially in Florida, if you do loans in Florida, you will run into insurance challenges at some point if you haven't. It's just and it's tough because some of those we don't have a workaround for, and some we do. But by any means, if you can get that up front, Paul and his team can take a look at it and see what we see on it. There are some things that if it's wind related, there are some options we may be able to give them about getting a wind buyback policy. Obviously it's going to cost the HOA money though, and that's the key. Right now insurance is expensive. I mean, like Paul said, we live in North Carolina. I just got my homeowner's renewal and my premium went up $800 this year. So chump change compared to what HOAs see when it's 50, 60,000, 500,000. I mean, depending on how many units they're insuring. But yeah, mine just went up $800 too. So definitely lots of changes and struggles in the insurance world.
Yeah.
And the one thing I would just tell realtors to be careful of, because on my situation, the realtor was saying, "Oh, well, I know I've got somebody that can do it." Just because somebody says they can do an unwarrantable condo doesn't mean they have a solution for your problem, the insurance problem, because some of the brokers that deal with unwarrantable condos, the insurance issue, they're running with Fannie and Freddie. They're not going to side of that
Yes.
box. So just be careful. Just because someone says, "Oh yeah, I've got a solution, I can do unwarrantable condos," do you have a broker that does it for this reason, whatever the reason may be?
That goes back to getting the
Right.
information
Yep.
up front, asking the questions, getting the insurance, the questionnaire, sending it to us. Take advantage of us being able to review that stuff up front, you guys, so you know exactly the reason it's non-warrantable, so you can be specific, because that's when it blows up at the end. So
yeah, that's a great point. The reason why it's non-warrantable is always important, because, and I've seen some misinformation out there, people saying projects are non-warrantable, and then we get information in and we're like, no, this project's okay. Now, insurance is usually the difference, but we've seen different reasons, and sometimes people will throw the term non-warrantable out there somewhat loosely. I've heard people say it's non-warrantable for budgets, and then we've looked at the budget and it's been acceptable. So you never know. I mean, if another lender says it's no good, is that true? Perhaps, but we would certainly always put some eyes on it and see, is their decision correct? The one thing we will see a lot of too, and I know we could talk this all day long, the Fannie Mae has their condo project manager system, which they will flag projects as unavailable if lenders notify them, which we are contractually obligated to do within 5 business days if we identify issues with projects. I was talking to one of our Fannie Mae reps about 2-3 weeks ago, and she said they have people, all they do is manage their mailbox all day long, flagging projects for insurance that lenders are reporting to them. So keep that in mind. If it's turned down by another lender for bad insurance, there's a good likelihood they're going to notify Fannie about it. So it's going to be put on their unavailable list too. So as you're talking to HOAs and property management companies and other people, they're saying, well, I can get this done. You won't. I mean, because once Fannie flags it as unavailable, lenders cannot deliver a loan Fannie Mae. It'll immediately get blocked at the delivery point. Freddie Mac is coming out with decline projects as well. They're just not there yet. They're starting to put some in their system. They also have the same expectation that lenders are notifying them. So, if there's a belief within, HOAs and management companies that, well, this is just a fairway thing, or this is just such and such a lender, that's not the case. I mean, because they will get flagged by Fannie, they will get flagged by Freddie. So it's important that the HOAs are taking this seriously, because nobody will get financing eventually, and that's going to be the hard part. Unless you can find somebody who's non-warrantable, but then, then you're talking higher interest rates and lower LTVs and the other things that go along with those types of products. So obviously everybody wants to have a conforming eligible property to get the best financing options. And to do that, they have to get some of these things in order. And again, some of them are not fully within their control. So it's something that we're continuing to monitor and have those discussions with both GSEs.
Last thing, networking opportunity. If you're a realtor and live in a condo yourself, joining the HOA board might not be a bad idea to make sure your complex is warrantable and you can sell them all then. So just a little marketing tidbit for the end. But I'm going to go ahead and stop recording. I want to thank everybody for coming. Thank you, Scott and Paul, so much for your time. So much information, very helpful. And I'll get this PowerPoint and this recording out to everybody. Thank you so much for coming.